Thanks for joining our quarterly webinar, Dave. Let's start with U.S. economic growth, which once again has confounded most professional economists.
Thanks, Joe, and welcome to our viewers. I'm happy and pleased to share my thoughts on the U.S. and world economies and markets.
So, Dave, 3 months ago, during our quarterly webinar, you displayed this slide showing the consensus view of about 70 professionals interviewed by the Wall Street Journal. With the Atlanta Federal Reserve forecasting that the U.S. economy grew at 2.5% for the first quarter, have the experts made any adjustments to their predictions?
Indeed, Joe, the Wall Street Journal panel got it wrong in 2023, and it looks as though they are getting it wrong again this year. As I mentioned during last quarter's webinar, the panel expected zero growth and a probable recession in 2023. The U.S. economy, however, produced stellar performance with real economic growth of 3.1% and no recession in sight. Now, coming into 2024, while not as pessimistic as they were at the beginning of 2023, the economists collectively felt the U.S. economy could grow no more than 1% for the year. But as you pointed out, Joe, it looks as though first quarter growth exceeded 2%. I've updated the chart you showed earlier with the most recent estimates from the Wall Street Journal panel. They now believe that the economy will grow at 1.7%, which is a bit lower than the long-term averages. What's more, the solid economic growth the United States is seeing is much better compared to the rest of the developed world. This next chart is one that you saw and posted to our internal Teams channel. It compares the evolution of economic growth estimates for the U.S. and 4 other countries and the Eurozone. A year ago, global economists surveyed by Bloomberg predicted that the countries of the developed world would grow between 0.5% and 1% in 2024. And as our viewers can see on this chart, while economists have steadily increased their predictions for the U.S. economy, they've decreased their forecast for the rest of the developed world to between 1/4 and 3/4%.
So strong U.S. versus slower developed world growth has been a popular topic with our investment team. So why do you think that is, Dave? What is it about the U.S. economy that is so different from the rest of the developed world?
So I've read about several different reasons why growth continues to exceed expectations for our economy, as well as growth rates for other countries. First, U.S. government stimulus, both past and present. In addition, both the Infrastructure Bill, otherwise known as the Inflation Reduction Act, and the CHIPS Act have provided additional economic stimulus. Second, consumers continue to spend despite depleting savings and increasing relying on credit for purchases. We collectively developed spending habits coming out of the pandemic, and we've been slow to cut back on our spending levels. Third is the impact of immigration. Long term, there are only 2 factors that account for economic growth: an increased labor force and increased productivity. We know that the native-born population is shrinking, and the foreign-born population increased significantly over the past several years. Speaking of productivity, a fourth explanation could be the contribution of generative artificial intelligence and its impact on productivity. That game is still in the very early innings. I can attest to how the various chatbots have helped enhance my own productivity, and I know that I've just scratched the surface. I do believe that a small portion of the growth we are currently seeing can be ascribed to advances in artificial intelligence, though I should note that productivity enhancements from AI would not be something that's unique to the U.S. economy. So, Joe, why do you think the U.S. is doing so much better than the rest of the world?
Yeah, so Dave, I agree with all your points on how the U.S. has managed to maintain its growth versus the rest of the developed world. The point I think is somewhat scary is the level of stimulus, because the stimulus won't last. And when it abates, we could see more even growth between the U.S. and the rest, at least, of the developed world. So one big picture theme that we talk about all the time is that the United States, we have oceans to the east and the west, and we have friendly neighbors to the north and south. The United States also has all its own natural resources, whether it's food, oil, minerals. And while we're still dependent on foreign manufacturing, you mentioned the CHIPS Act, we're starting to reshore. So we have a lot of advantages that are just very natural to our geography. And it might be worth considering some of the differences compared to other parts of the world. So I think about, for example, Europe and Japan. Europe is an old economy, both in terms of its population, and Europe's old in terms of the kinds of businesses that exist there. And if you look at the S&P 500, we look at about 40% is in the technology and technology-related sectors. Europe is about half that. Japan slightly more than 20%. But then the U.S. clearly is benefiting from these large companies and technology companies, and like you said, that on the generative AI. And I think that thinking about Japan, one could argue that their stock market started with their rally, I should say, started with the structural reforms, but also a really sharp weakening of their currency. So all that being said, do you think that the U.S. can continue to lead the world? And if so, how long?
So while I agree with most of your thoughts, Joe, I'm a bit pessimistic about the extent to which the U.S. can continue to outperform the rest of the world. What worries me is growing debt burden and the costs associated with servicing our rising debt levels. So let's take a look at this next chart. The data that comprise the chart on the left is taken from the International Monetary Fund's most recently published World Economic Outlook. It compares the history and the IMF's projections for debt as a percentage of our economy, GDP, for both the United States and the European Union. While we saw meaningfully increases in debt levels for both the US and Europe coming out of the great financial crisis of 2008-2009, the Europeans gradually lowered debt levels until COVID hit and are projected to continue reducing debt levels for the next 5 years, absent any unforeseen crisis like the GFC or COVID. Yet the trend for US debt levels continue to drift higher. Now on the right, we can see that debt service costs have skyrocketed and exacerbated by increased interest rates. The federal government's interest costs on the debt now surpasses a whopping $1 trillion a year, or around 15% of the total US budget. I would argue that economic growth cannot be sustained if we continue to pile up debt and interest costs. Taxes will inevitably have to rise, which will certainly have a dampening effect on economic growth.
So Dave, that's a good segue to what the next topic of interest for our viewers, and that's the Federal Reserve's plan for lowering interest rates. So let's take another look at your earlier slide showing the change in economists' expectations for 2024. At the beginning of the year, the consensus view was that the overnight Fed funds rate would drop to 4.25% at the end of this year. And as I think many of our viewers know, the Fed funds rate is the overnight lending rate for surplus bank reserves loaned to other financial institutions. It influences the interest rate charged throughout the economy. As we've discussed in the past, high interest rates, in theory, are supposed to slow the economy down, resulting in higher unemployment rates or lower rates of inflation, or both. The Fed targets an annual inflation rate of 2%. If inflation rates are higher, the Fed will increase rates until it has slowed economic growth and its target rate of inflation has been reached. But with continued economic growth, and now including low unemployment, and inflation remaining stubbornly above 3%, the market optimism for 3 or more rate cuts has diminished to maybe 2, and one Fed official suggesting we might not have any rate cuts until 2025. So just last week, we saw that the inflation rate inched up higher than the prior month, which further decreased the likelihood of any rate decreases. So what are your current thoughts on inflation, Dave? Do you think that inflation rates will approach the Fed's target at 2% anytime soon?
So I remain less than optimistic, Joe, that inflation rates can breach the 3% level for much of the rest of the year. First, as we've talked about, consumer spending remains strong, which puts upward pressure on prices. Second, we've seen a recent spike in energy prices. Oil prices are up over 20% since the beginning of the year. Though the Fed looks at inflation numbers that exclude oil price shocks, reality is that higher energy prices influence the cost of producing the goods and services that the Fed does factor in its inflation calculus. Third, We've seen unusual spikes in things like auto insurance and hospital costs, which are adversely affecting the inflation numbers. Going back to the Wall Street Journal survey, economists appear less optimistic compared to the beginning of the year that inflation will close in on that 2% goal.
So I guess that's another way that we differ from the other developed countries. Last week, the Statistical Office of the EU, or the European Union, reported that their annual inflation rate fell to 2.4% in March. On cue, the financial community expressed increased levels of optimism that euro area interest rates were going to have cuts in the near-term horizon. Their report showed that energy prices declined 2%. Much of the decline is attributable to the drop in natural gas prices. Last October, the price of natural gas in the euro area reached a high of nearly the equivalent of $60 per megawatt hour. Prices have dropped to less than half that amount, which is still significantly higher than what U.S. consumers pay for natural gas. If the European Central Bank lowers its lending rate and our Fed maintains rates, we should think that a stronger U.S. dollar and higher interest rates, because the higher U.S. dollar because it would attract higher interest rates. What are your thoughts on whether the stronger U.S. dollar is a positive or negative for markets?
Well, while a stronger dollar may provide a psychological advantage, let's not forget that it also means that products and services offered by U.S. companies are less competitive compared to their foreign counterparts. And we will lose business to the cheaper goods and services that are produced outside the United States. And as you recently reminded me, Joe, historically, the global markets have tended to perform best in periods where the dollar is somewhat stable and weakening.
That's true. So it'll be interesting to see what the data reveals over the next several months and how the Fed reacts. So let's move on to business conditions, Dave. How have business conditions changed for the first 3 months of 2024?
All right, so let's first look at the monthly survey of purchasing managers. Each month, the Institute of Supply Management poses a series of questions to company purchasing managers. The first question is, are business conditions better or worse than last month? A score of 50 means that half the respondents said yes and half said no. Hence, a number better than 50 means business conditions are positive. Less than 50 means they're not. As we can see on the chart on the left-hand side of the next slide, business conditions for manufacturing have been not so good since November 2022. However, in March, manufacturing conditions turned positive. On the right side, we see the responses from purchasing managers of companies in the services sector. There we have seen a steady decline in conditions, but they are still positive. So overall, business conditions look pretty good. What's more, the profit picture for large businesses continue to improve. As you can see in the next chart, the S&P 500 experienced solid earnings growth in the second half of 2023, and analysts are forecasting continued growth into 2024 and 2025. The forecast of about 2.5% growth for the first quarter would be significantly better were it not for 20% plus earnings declines in the health, energy, and materials sectors.
As I understand it, Dave, the ISM surveys is the corporate purchasing managers of larger companies. And this last chart you showed shows earnings growth for the S&P 500 largest companies. So what about small businesses? They're the backbone of the economy. Are they also experiencing positive business conditions?
Well, Joe, I wish I could say that small businesses were flourishing, but that's not the case. This next slide displays the results of a monthly survey of small businesses, and we are continuing to see a steady deterioration in their level of optimism. In fact, small businesses today are less optimistic than they were at the nadir of the pandemic, the worst reading in over 11 years.
So why do you think that is, Dave?
Well, according to the National Federation of Independent Businesses, which conducts the survey, small business owners are reporting that they are increasingly adversely impacted by inflation. They've seen their profits squeezed as labor and supply costs are increasing more rapidly than the prices that consumers are willing to accept for the products and services that the small businesses provide. In addition, they've had difficulty borrowing money at interest rates that they can afford. This latter point is definitely a direct result of the Fed's interest rate policies that we discussed earlier.
So, Dave, before we wrap up, is there anything you'd like to add regarding international markets?
As we noted earlier, Joe, economists expect tepid growth for the rest of the year, though inflation is cooling faster than here in the U.S. Manufacturing continues to be weak in the developed world, though on fire in India, now the world's most populous country. In addition, like the U.S. this year, many countries will be conducting national elections, which adds to the uncertainty. Compound that uncertainty with conflicts in the Middle East and Eastern Europe.
So, Dave, speaking of the election, are there any thoughts about the U.S. election that may influence the markets?
Not really, Joe. I suppose a landslide by one side or the other could have a significant impact on certain market sectors. For example, if we saw a Republican landslide, one might expect a significant upward move in the oil and gas sector. Conversely, a Democrat landslide would be positive for the renewable energy sector. But as you mentioned earlier in the week, Joe, one of our asset managers has frequently reminded its clients that elections have not been big drivers of returns overall, and I honestly don't expect that it's going to be any different this year.
Well, Dave, thank you very much for your thoughts, and thanks for joining.
Good to be here.